If 2025 has taught us anything thus far, it's that we're actually in for quite a ride. Now, we've already experienced some low lows in the red before Trump stepped back into the Oval Office to some optimistic higher highs. Then we followed that up with yet another market slump as investors are just too uncertain about what the heck all these policy changes and shifts are going to bring about for all of us. However, if I can, just for a moment, restore some calm and ease out there that really might be brewing, I just want to share that investing is all about thinking in decades. Yes, decades. If you're a real investor, this means then that the news from the day-to-day or the week-to-week or even on the year-to-year basis shouldn't really concern you much. Of course, the real savvy investor out there is going to be myopically focused on really three pieces of essential criteria that I talk about quite often here on the channel. They come down to a company with a strong and reputable brand name, a leadership team that can take the reins and advance a company into the future profitably, and finally, the healthiest of signals here, which all comes down to a clean balance sheet, meaning little to no debt. So for the most part, you can shrug off a lot of the market's concerns if you are in fact a younger to middle-aged investor. Of course, if you are nearing retirement, you'd really want to have your head a bit more on the swivel just so you know what's going on and know what to stray away from. But for anyone else, time will be your best friend, and you'll just have to invest into companies that meet these three pieces of criteria that I just mentioned. And in order to help you at least get your eyes on some real dividend gems right now that are just worth your attention or even buy-in, I want to go ahead and run through 6 dividend stocks with you. So we're going to go ahead and kick off with a dividend stock that I don't know if I've ever really mentioned here on the channel, but it's California Water Service Group, ticker symbol CWT, which if you had your ears perked up listening into the news, you know that California has literally been burning up in flames. And without the necessary resources for emergency responders to get their job done, coming right down to water, not even pumping out of fire hydrants. Now, as a former firefighter, my heart really does go out to all of these first responders and even the victims here of all of these raging fires because there's no water to put them out. Either way, this company is on the list not necessarily because they are to blame for the dry hydrants, but rather just because many California-based companies are actually taking a beating right now, meaning they're on sale. And with California Water Service being the 3rd largest water utility company within the United States, it's just a very reliable company with a bounce back likely in their future. We're going to see that it's currently down by almost 8.5% on the year. However, I do want you to go ahead and take note of the fact that over the 5-year period, we are down almost 20%. So if you are going to buy in on this dividend stock, you're really going to have to buy in on the dips to ride the waves of upside. But I do want you to take note now of the fact that revenue is in fact still there, and we can see that here in the chart as we scroll down, which makes sense. And most importantly, the company itself just keeps a very clean balance sheet, assets coming in at $4 billion and to liabilities coming in at $3.1 billion. Now, as for the dividend, let's go ahead and click over to Simply Safe Dividends to discover a 99 on the safety score, along with its 2.59% dividend yield, and scrolling even further down, a 32% payout ratio here, which is very low for a utility company, while it also delivers through on 56 years worth of a dividend streak, while growing that dividend year over year by about 3%. But if you're really now looking for a bit more of dividend growth, and more importantly, for some of the dividend seekers out there really enjoying a higher yield, you're going to want to get your eyes on this monthly paying dividend stock. You might be able to guess what it is. We have Realty Income, ticker symbol O. I know I don't really need to introduce this one to you. If you are a true dividend investor, you likely already know all about this REIT, but I want to tell you that it is just the industry leader, meaning plenty of reliability when it comes to their ability to maintain their net leases, over 15,000 properties that span across the United States and abroad. And on top of all of that, just 1,000 plus clients to lease these properties out to. Again, that just spells reliability, which is what all of us dividend investors are really seeking. Now, most importantly is just to know that REITs in any really real estate sector plays are really susceptible to interest rates and mayhem when interest rates are high. So clicking into the stock chart, we're going to see that right now Realty Income is depressed in the red, trading for $54 per share after sliding from $64 per share from the Fed announcement as they pushed interest rate plans back. Now, if you click out to the 5-year chart, you're going to discover that the stock never really rallied back up to the pre-COVID highs, and that is because our economic environment has yet to be really friendly towards REITs and real estate. But when interest rates really do come back down like they did, say, back in 2021 and 2022, well, you can see for yourself there, Realty Income soared back up to $70 per share. But now scrolling down, we're going to see that Realty Income's real power here is with over 22 22% worth of a revenue increase. And scrolling down a tad bit more, we're going to uncover that a balance sheet here is very clean. As we can see, total assets have increased by over 16%. That totals them out to over $57 billion in assets. Now, clicking right into Simply Safe Dividends, we're going to get a safety score here of an 80 along with a 5.85% dividend yield. Again, a monthly payer on our hands, so this is just a beautiful opportunity for income seekers, and this is all made possible by their lower payout ratio for REITs here at 75%, while Realty Income keeps it on a good dividend streak here of 55 years strong, continuing to deliver through on some growth as well, about 5% year over year. But if real estate isn't your thing, or you don't have room in your portfolio for real estate, I do want you to go ahead and get your eyes on a stock opportunity that really has been in disarray just based on the fact that, well, a lot of companies have been cutting back on advertising and marketing. So we're going to get to it here with an advertising and marketing play with none other than Omnicom, ticker symbol OMC. And I'm bringing this to your attention just given that Omnicom is in fact the largest advertising, communications, and PR powerhouse in the world, with thousands of clients that range from Apple to Nike, Nissan, McDonald's, Pepsi. I mean, you name it, they're probably in their book of business. All the big players of each industry really are. But like I said, when the market is in a very iffy spot and companies start to pull back on their budgets, well, a lot of these advertising gems are hit. Omnicom, no exception, at lower lows here of $86 per share after just trading for over $100 per share weeks to months ago. Now, the real question to ask yourself is, if there's a lag in the economy, will advertising bounce back? And of course, that answer is absolutely. Now, Omnicom will likely be there for the business, so clicking out to the 5-year chart, we're going to see that Omnicom is in fact a reliable and steady player, climbing by about 11% their worth of appreciation. Now, scroll down with me to find net income that has increased, which is a very healthy sign, even that's despite all the market affairs. And then we have a balance sheet that also shows us that it's very healthy all around. Definitely would recommend looking into Omnicom. And clicking over now to Simply Safe Dividends to get a peek at this dividend, we're going to be greeted with a 70 as a safety score, a solid 3.24% dividend yield to go along with it. And then we're going to have here this payout ratio that's coming in at just 36% with a 38-year dividend streak thus far. But we're also going to be able to experience some more dividend growth here with Omnicom thanks to this solid average growth rate here of 10%. Now, investors, 3 down, that means 3 more to go. And honestly, the next 3 are not only all in my portfolio already, but picks that I personally remain insanely bullish on. However, before I actually break them down, I want to jump into some YouTube stats with you to share that I see that more than half of you, 55% of you, are tuning into my videos, video to video, every single week, but not actually subscribed. So I want to go ahead and ask you right now directly to subscribe to the channel. That helps me out and honestly helps you out and just keep it in the know to know. Now, while we're at it, tap on that thumbs up button if you are in fact getting value from this video. That tells me to make more videos just like this. But with that, we're going to kick right back into it and get kickstarted here with Lockheed Martin, that's ticker symbol LMT, which is the world's largest defense contractor and Uncle Sam's best friend, as the United States government remains Lockheed's nearest and dearest client. Over the last 4 years, there's been plenty of mayhem around the world, which prompted a ton of defense spending. And Lockheed was at the receiving end of all of this. So we see that the stock actually shot up to some higher highs with these global wars. But now with these wars seemingly coming to an end, we've seen Lockheed slide by over 18% since Trump's hard-toned messages to other global leaders. And now these global leaders are wanting to come to the table to speak with him, which means we now have an opportunity on our hands to buy Lockheed at a much more affordable price. It was at over $600 per share, now trading for $497. Now, clicking to the 5-year chart, we're going to see just steady growth, which is very likely to continue as the world is likely not to go without conflict. Scroll down with me, we're going to see an income statement that's depicting plenty of revenue flowing into Lockheed Martin, and then an even healthier balance sheet, whereas we're going to find assets amount to over $52 billion, whereas liabilities follow suit at around $45 billion. In terms of the dividend, we're going to go ahead and click into Simply Safe, and we got nothing to worry about here as well. Safety score coming in at an 84, along with the dividend yield coming in around 2.65%. Now scroll down with me, we're going to get a payout ratio here around 45%, while Lockheed remains on a 31-year dividend streak thus far, while also boosting that dividend year over year by an average growth rate here of 16%. Now, investors, the final 2 mentions on today's list, if you're in your 20s, your 30s, or your 40s, should be highly considered just because of their growth potential deal. Yet if you're someone out there that's just all about the dividend yield, I think you're doing it wrong, but that's all on you. We're gonna go ahead and talk about Apple, ticker symbol AAPL up first here, which, well, is Apple and continues to lead the tech sector. But news out of China rather recently has been that sales are declining, and that's been blasting Apple's share price. But nonetheless, we're now getting an opportunity to get Apple that was trading above $250 per share not long ago, now around $223 per share. My take is you better be buying the stock this year and not the new iPhone, because clicking out to the 5-year view here, you're going to see that Apple soared by over 181% worth of share price appreciation. And scrolling down, we're going to see that revenue, well, even despite all this China mayhem, is still showing revenue generation. And the balance sheet remains very clean as well, with assets trumping over $364 billion. Now, when I look into the future, well, Apple is in development of AI and at the forefront of continuous innovation. So I think long term here with Apple, and I see a beautiful opportunity as a tech sector gem that's going to pay out a small dividend along the way, but nonetheless a dividend. So we are going to get a safety score here of a 99 with a 0.45% dividend yield, along with that 15% payout ratio. Though it's only been on a 12-year streak, I'd only imagine that we have plenty more years worth of dividend growth to come, as well with the current dividend growth rate here of 8% to enjoy. And if Apple isn't your ideal tech investment or growth opportunity, well, I'm telling you right now that this one is an absolute must have your eyes on. Alphabet, ticker symbol GOOGL, for obvious reasons like Google being the search and advertising whale of whales, but more so because of recent news with AI and quantum computing technologies, and Google really leading this charge at the point that Willow is just the thing. And thanks to Trump just signing a $500 billion package to advance the sector, Alphabet will be a great recipient of the momentum here, and already, as you can see, clicking into the stock chart, soaring to higher highs, trading for $197 per share as of this video. Click out to that 5-year view, we're going to see over 170% worth of appreciation, and it's my bet right here to you that you really can't go wrong with this one, as the future remains in the tech space with AI and quantum. So now scroll down with me to see plenty of revenue generation while they maintain one of the cleanest balance sheets that I personally have ever seen as an investor. Over $402 billion in assets to just $119 billion in liabilities. And that's increased by over 10% there in terms of assets. Now clicking into Simply Safe Dividends, we are going to get a safety score of an 80, and yes, a much smaller dividend yield year, as you can see, at 0.4%, but it's going to reward you well and plentyfold if you're invested into Google for the growth. Not to mention, I can easily see Alphabet just being a growth powerhouse when it comes to that dividend, only right now at a payout ratio of 5%, which is nothing for them. But there you have it, investors, all 6 dividend stocks. I want to know your thoughts on these 6 dividend stocks, or if you have better dividend stocks in mind for the entire community, let us all know down there in the comments below. Be sure to tune in right here to catch the story of a true dividend millionaire. Don't forget to subscribe, and with that, I will catch you all in the next one.